everyone, this is Swarnam, Assistant Professor of MBA Department of SNS College of Technology. Friends, in today's session we are going to see a concept under capital budgeting. So before entering into the session, can anyone guess what the topic it would be about? I judge an investment using average profit, not based on the cash flows. I compare the profit with the capital invested, and I always speak in percentage. I rely on the figures from the profit and loss account and not on the present value. So who am I? Yes. So in today's session we are going to discuss the topic about accounting rate of return or average rate of return. So that is what we are going to discuss in today's session. So before entering into today's session, we shall have a short recap of the previous session. So in the previous session we were discussing on the payback period, and what is payback period is all about. It measures the length of the time which has been required by the company to recover their original investment. So in the previous session we were seeing about the silent features of payback period, and we have also seen the limitations of payback period method. So now we are going to see about ARR, that is accounting rate of return. So when we talk about the accounting rate of return, it is called as average rate of return or accounting rate of return, which is always been represented in percentage. So accounting rate of return is calculated by the company when they are been investing their projects in machines or heavy equipments, or when they are investing in some new projects. So accounting rate of return is also one of the technique in the capital budgeting, as similar to the payback period. So average rate of return, the formula for calculating the average rate of return or accounting rate of return is average annual profit divided by original investment into 100. Average profit in the sense the total profit divided by number of years is what called as the average profit. Take in case if my company is having 5 years of profit, so what I will do is I have to add all the 5 years profit and I have to divide it by 5. So that is what called as an average profit. So total profit divided by number of years is what the average EAT. So average EAT divided by original investment into 100 is what the formula for average rate of return, which has been always been expressed in percentage. So how to calculate average rate of return? We will see this process step by step. So first and foremost thing is we have to calculate the average annual profit. So the projected profit of a company, that is say for if the company is expecting for 5 years or 6 years or 10 years, so whatever it might be, so earnings divided by number of years, that is what average annual profit. So when we are calculating the accounting rate of return, we will use EAT. EAT in the sense earnings after tax. That means in earnings before interest and tax, we will deduct the interest and we will deduct the tax, and finally we will determine the EAT. So out of EAT, the total EAT divided by number of years is what called as an average annual profit. So when we are calculating the average rate of return, the step number 2 is accounting of depreciation. So always we will calculate the depreciation for all the assets, right from equipments, machinery, all the assets we will calculate the depreciations, right. So we have to deduct this depreciation from the profit, then only we have to measure the earnings after depreciation and interest and tax. So that is how we have to measure the accounting rate of return. So finally once you have been computed with your average profit, we have to divide it by the initial cost. So average annual profit divided by initial cost, and that amount is to be multiplied by 100 so that you can express this accounting rate of return in percentage. So accounting rate of return, what ARR means for your business? So obviously it helps us to evaluate the investment. So it helps us to determine whether the profit is, the project is feasible or whether it will earn a potential result for the company, return for the company. The other one is it helps us to compare with the other investment opportunity. Take in case if I have an opportunity to invest my project in 3 projects, project A, project B, project C. Project A, if my accounting rate of return is 40%, project B, if my accounting rate of return is 50%, and project C, if my accounting rate of return is 60%. So which project I will go? Yes, so I will go for higher rate of return project. So I will go for accepting the project C. The reason is it earns the highest rate of return compared to the other projects, right? So this is how we have to decide about the investment in project using accounting rate of return. So it helps us to decide about the feasible project for the company. So friends, in today's session we were discussing on accounting rate of return. We have seen what is accounting rate of return, we have seen the definition, and we have also seen the formula for calculating the accounting rate of return, that is average profit divided by original investment into 100. So it helps the company to measure the feasible projects, and we can easily understand which project is feasible for the company, and based on that we can go for taking the investment. So hope you all understood with today's session. Meet you all in the next session. Thank you. Thank you for listening the video.